Today is Friday, December 18th, 2020, and I'm your host, Max Gottlich, and I talk about my interpretations of financial markets and the overall economy. Risk assets are surging higher. In fact, Tesla just made a new all-time high as the dollar continues to fall and it's almost at a 6-year low. I believe it's 2 to 3% away from a 6-year low. And so the new norm is stocks go up when initial jobless claims was last at 885,000, which missed expectations, and with total claims totaling over 20.6 million people. So of course, the speculative mania bubble in Bitcoin continues to prevail as the catalyst is more hedge funds, and even Michael Saylor, of course, buys hundreds of millions of dollars worth of Bitcoin, like $650 million. And as we know, hedge funds are short-term traders. They make short-term trades, generally speaking anyway, and they're following the momentum. And the smart ones are, the ones that are using their influence, whether it's through leverage capital or through their institutional influence, to literally front run everyone and bidding prices even higher. So, and it's even more insensible that investors in GBTC, like, Grayscale, they're paying right now a 35% premium over net asset value. That's kind of ridiculous, but they don't seem to care. And the Fed's balance sheet reaches a new all-time high of $7.3 trillion, which, not surprising, because as the Fed declared, they would increase the pace of purchasing treasuries. And speaking of the Fed, they actually own more treasuries than foreigners do for literally the first time since the 70s. So if you watched last week's video on the national savings and investment identity, you'd understand why this is a big, big problem. We need foreign payments to the US, and we're not seeing that. And foreigners, they may not be selling the treasuries, but they are buying much less of them than they used to, because they're finally realizing the devalue of the dollar and its worthlessness. For example, the Reserve Bank of India has foreign exchange reserves totaling a record $560 billion, which is mainly comprised of gold, right? They mine and invest in a lot of gold. And more recently, risk-free deposits and even AAA corporate bonds. And, just like the US Fed, they buy junk bonds and corporate debt. And so does the Swiss National Bank. They buy US equities outright. So all over the world, you see this. But India does not even want dollars because dollars do not yield a high enough return. So just like individual investors flock into risk assets and borrow from home equity lines to invest in these speculative call options, and central banks are ultimately doing the same thing, but at a much larger scale. So as we could see in the next slide, the Wall Street Journal, they published a pretty interesting chart, and it confirms we're nowhere near an economic recovery. And in fact, we're headed into a sovereign debt and liquidity crisis and a dollar crash crisis. The chart shows the cumulative bankruptcy cases filed by the biggest PPP loan recipients. So as you could clearly see, it's only been increasing, and last month was actually the largest, November. So PPP money is a primary cause for lower borrowing, and it's made a lot of businesses become a lot more profitable. And some of these businesses, a lot of them that you hear in the media, they didn't need PPP initially, but they got it anyway. Well, if there was one thing the government maybe did do right after all, and I say that very, very ironically, sarcastically, is they fined Robinhood $65 million. This was kind of big news the other day because they misled their customers, most of which, they inexperienced. A lot of them are inexperienced traders, and they failed to prevent outages on their trading platform. So you probably remember the story of one of these outages when a teenager killed himself. He committed suicide because he thought he lost $750,000 when he actually, when it was actually just a glitch on the Robinhood platform. So they also lied about how they make money by encouraging investors trading as commission free, which, it's because they have unusually high payment for order flow rates, which pretty much means customers' orders were executed at really bad prices relative to other brokers' prices. And of course, the government did not do anything right because everyone who uses Robinhood suffers, and the SEC gets to keep the $65 million fine. So we know at some point there will be too many reserves in the banking system. And because as we know from previous videos, QE is not money printing. And because the Fed credits commercial banks in their reserve accounts, that's why. So the Fed is nothing more than a bookkeeper, and they transfer wealth from one area of the economy to another. That's it. And in turn, the Fed spends this fake paper money that's printed in the TGA, or the Treasury General Account, where fiscal money, it effectively becomes a line item on the Fed's liabilities in their balance sheet, uh, which is really, we're going to get right into QE and how it works right here. And you could read this quote for yourself. It's a letter from John Adams to Thomas Jefferson all the way back to 1787. And he's basically saying that, a devaluing of our currency is pretty much the worst thing that could possibly be done, most artificial thing that could be done, in with the help of the government's monopolized version of free market economy, which is not free. So today, I also wanted to specifically talk about how, again, quantitative easing works, and because clearly there's very important misinterpretations I hear all the time regarding QE. So let's start with the Federal Open Market Committee, right? The FOMC, where they changed the federal funds rate to achieve price stability. And the Fed funds rate is, for those that don't know, it's just like an overnight lending rate for banks. But in order for QE to work, the Fed needs to continue their large-scale asset purchases so they can artificially increase the demand for Treasury securities, which will raise the prices. That's the effect. Prices will rise. This kind of QE approach has been used continuously throughout history. It all started with really Japan, but it was used by the Fed in the 30s, and it was, Japan mostly throughout early 2000, like right after their, the Asian crisis. The Bank of England, which more recently, when they bought 70 billion pounds of government bonds and corporate debt, and that suppressed rates like they wanted. That was, I believe, just after the housing crisis. Another reason for use of QE is apparently to increase the availability of credit in, throughout private markets to support mortgage lending and, the overall housing market, which is much of what we saw in '09. The great financial crisis. And the Fed enabled this artificial recovery in the housing sector by purchasing $1.25 trillion in mortgage-backed securities. So this was the only first round of QE. There was a second round. And today, currently, there's been many rounds upon many rounds. So because of QE, the monetary base increases, which means an inflationary outcome will happen, but banks hold large amounts in reserves. So if they were to loan out these reserves, it would actually increase the money supply. But of course, we don't see any lending growth today, and credit is contracting, and hence the deflation bugs are pretty much spreading like wildfire, right? Everybody's talking about deflation, but they're wrong. And as we know, all of this devalues the currency, which makes imports more expensive, and it'll increase the cost of production and even consumer prices. So QE is essentially one big snowball effect. And that really started after the Federal Reserve Act of 1913. and really technically started in the days of Greenspan, who, as we know, is the longest serving chairman in history. So with that being said, I hope this was enjoyable and you learned a little bit more on why QE doesn't work. And also, on another note, I'm constantly looking now for interviewees for my new podcast show, which will really only be released on this YouTube channel for now anyway. Um, but I'm really excited for the future of this channel. And as always, guys, thank you for watching, and make sure to subscribe and like the video. And please note, I'm not a financial advisor, and everything I say is for educational purposes only. All right. Thank you, everybody. Have a great weekend.